Okay, let's look at the principles of insurance. There are some concepts that we need to look into when you're talking about the principles of insurance. The first one we'll be looking at security. That is number one. What is the security? It applies to long-term insurance where the insurer or the insurance company undertakes to pay out an agreed upon amount in the event of a loss. So when we're talking about security, it means, okay, I have my premium with the insurance company. If anything happens to my business, I will be compensated. And at the same time, it's going to be an agreement from the part of insurance company to pay you out in the event of a loss of life. And it's also a predetermined amount that will be paid out when the insured reaches a predetermined age or gets injured due to a predetermined event. Predetermined age, maybe at the age of 18, maybe at the age of 65. It's always been stipulated, or in the case of an injured person due to certain or predetermined event. It also aims to provide financial security to the insured at retirement, the dependents of the disease. So when you're talking about the retirement, okay, at 65, but in a situation whereby you took out a life insurance or all these life policies, it's only the dependents that are going to benefit from that dependent of the disease. That is, when the person dies, then the payout will be given to the dependent. A dependent can be the wife if it's the death of the husband, or the dependent can be the children. Whoever is being stipulated to get the payout will be paid by the insurance company. So the second principle we'll be looking into is indemnification, or we will refer to it as indemnity. Usually applies to a short-term insurance as the insured is compensated for specified or a specified loss. So before I even go into the indemnification, when you're talking about security, I actually want you to underline it is a long-term insurance that is being done by an individual or a business. And when you're talking about indemnification, it is applicable to a short-term insurance as the insured is compensated for a specified loss. Insurer agrees to compensate the insured for damages specified in the insurance contract in return for premiums paid by the insured to the insurer. It protects the insured against specified events that may occur. The insured must be placed in the same position as before the occurrence of the loss. The insured may not profit from the insurer. Let me try and explain the last sentence. The insured must be placed. So which means, let's take for example, from the example I made, let's take for example, I buy a wristwatch worth of 10,000 rand. And I go to the insurance company and I want it to be protected. First for women, as an example of an insurance company now tells me that, okay, ma'am, looking at the value of your wristwatch, it's 10,000 rand, and you need to pay a certain amount as premium every month towards that, so that if it's damaged, if it's been stolen, I can be compensated. So let's take, for example, I'm being asked to pay, maybe I have to pay 300 rand every month just to cover the loss. Yeah, the insurance company will buy me a wristwatch of that value. Insurance company, even if I have more than 10,000 with the insurance company. So one thing I want you to understand is that you do not make profit from the insurance company. The insurance company will only buy me a wristwatch worth of 10,000 rand, even if I have 15,000 rand with them. I've paid premium of 15,000 rand with them. So you don't make profit from the insurance company. The insurance company will put you back in your right position, in the same position that you went to them. So what was my position when I went to insurance company is that I've got a wristwatch of 10,000 rand, and if my wristwatch is lost, they will only buy me a wristwatch worth of 10,000 rand, even if my premium that I've given to them is 15,000 rand. insurance company will only put you in the same position as before. They cannot buy me a wristwatch of 15,000 rand, even if I have 15,000 rand with them for so long. And we have what we refer to as insurable interest. Insured must prove that he or she will suffer a financial loss if the insured object is damaged, loss, ceased to exist. So which means insured must prove that he or she will suffer a financial loss in that kind of a situation. An insurable risk must be expressed in a financial term. And we have utmost good faith. Insured has to be honest. That is a very important one. Insurable interest is also important, but the utmost good faith is very, very important at the same time. Insured, which can be the business or individual, has to be honest in supplying details. That is the utmost good faith. Supplying details when entering into the insurance contract with the insurance company. What is the utmost good faith? Being honest actually means if I want to insure my car, I need to be truthful and open up to the insurance company that I will be the only one driving the car. Which means if I say that to the insurance company, I cannot tell my child to drive the car. I cannot tell my siblings to use the car. I'm the only one that can only drive the car because I only cover myself in that kind of a situation. Both parties must disclose all relevant facts. So which means insurance companies also mustn't hide anything from the insured. The insurer must be truthful. At the same time, the insured needs to be truthful. That is what we refer to as the utmost good faith. Details, information supplied when claiming should be accurate and true. So if my car have an accident and it was my child driving that car, I cannot go to the insurance company and say, I'm claiming the car had an accident when I was driving. That is not an example of an utmost good faith, because I know that my child is not covered to drive that car. I only covered myself. If I want my child to drive that car, which means the risk, I need to spread to spread the risk. The risk needs to be spread a little bit more, which means I need to pay more in terms of the premium, because you see, I'm only covering myself. Maybe I will be paying 300 rand, but because I want my husband to drive, I want my wife to drive, I want my child to drive, I need to put more on my premium so that if anything happens, I can be compensated. So when you are entering a contract with an insurance company as an individual or a business, you need to always be truthful. Like you need to give the necessary details when you enter in a contract, and also when you are claiming, you need to be truthful, because insurance company will also make their investigation before compensation is being done or before you can be indemnified. And in a situation whereby you lie, it means you've already breached the contract between you and the insurance company, and there's always a penalty towards that if you are being found guilty. So we move on to more insurance concepts. So those are the four principles of insurance. We only have four principles of insurance. We have security, indemnification, insurable interest, and utmost good faith. So if I want to put it down, and I also want you to do it, I will just write SIIU. That is, for me, I'll be able to remember that is the principle of insurance, SIIU. And I'll move on to some interesting concept which you will also be coming across. Let's look at what reinstatement means. Insured is restored to almost the same financial position as before the loss. Insured, when you're talking about reinstatement, it means the insurance company will put you at the same position where the loss actually occurred. Like let's take for example the wristwatch I was talking about. If the insurance company cannot buy me a wristwatch of 10,000 rand, at least they'll buy me a wristwatch of 9,000 rand, not buying me a wristwatch of 4,500 rand. They put you in the same financial position. The insurer, number two, the insurer rebukes, which is the insurance company, rebuild or replace the damaged property instead of paying out cash. Can you see that? Insurance company will not just give you cash. They will rather rebuild or replace the damaged property. Number three, principle of reinstatement may be applied if the item was over insured. I will speak about over insured, I think, towards the end of the topic. And number two, we have excess. What do we refer to as excess? It is a clause. I actually want you to underline that. Some people actually call it an average clause. A clause which states that the insured is responsible for a fixed amount of the claim when submitting what? The claim. So which means this actually goes with under insurance that you see. Okay, I think the average clause is actually down. Okay. An excess means that you as the insured will be responsible in fulfilling certain part of the insurance contract. That is a fixed amount of the claim when submitting what? The claim. You have to cover all those. That is why we call it an excess. The insurance company will cover certain aspects, and you need to cover certain aspects, especially when you under insure your asset or your property. Then we have an average clause. An average clause, the insurer will only pay the average between the actual value and the insured value. I take that again. The insurer will only pay the average between the actual value and the insured value. This means that the insured will have to carry out part of the risk that is not being insured. So I actually want you to put it in bracket. That is where the excess actually comes from. I wanted to explain it with excess, but I could see there is a better explanation under the average clause. This means that the insured will have to carry the part of a risk that is not what? Insured. And this is mostly applicable. Wow. It's the third bullet. It applies to goods and items that are what? Under insured. Let's take, for example, that wristwatch that I was making an example with, it was 10,000 Rand. Then the insurance company tells me that, Mr. Yewo, if you want us to cover you or indemnify you in case something happens to your wristwatch, you need to pay 500 Rand as a premium every month. Then maybe I was not like, no, I'm not willing to pay 500 Rand. I will only pay 300 Rand. That is an example of what? Under insurance. So in a situation whereby I only pay 300 Rand and something every month as a premium to the insurance company, and something happens to my wristwatch, the business insurance company can only afford, let's now assume the insurance company can only afford to give me 6,000 Rand because I underinsured my wristwatch. And I actually want a wristwatch, another wristwatch of 10,000 Rand. Which means if the insurance company is willing to pay me 6,000 Rand, and I want to buy another wristwatch of 10,000 Rand, I need to pay an excess of what? 4,000 Rand because I've underinsured my wristwatch. And that is where the excess actually comes from. The moment you underinsure your asset, you must be prepared for an excess, because the insurance company will not give you more than what you've put with them. Even sometimes they give you less. That is what we refer to as what? An average between the actual value and the insured value. So an average clause actually applies to underinsured goods or assets. So in that kind of a situation, the moment you underinsure your property or your asset, you must be willing to pay excess. That is, you need to pay a certain amount in order to cover a full expense of that asset. Then we have what we refer to as overinsurance. Overinsurance, so before I go into overinsurance, most people actually go for underinsurance. People under-insure their assets because they actually know that if I over-insure my property, insurance company will not pay me more than this amount. So let's take, for example, I over-insured my wristwatch. Insurance company tells me, Mr. Yewo, the value of your wristwatch is 10,000 Rand. For you to insure it, you need to pay 500 Rand every month. And I'm like, no, I've got money, I've got excess with me. I want to over-insure it for 1,000 Rand every time. The insurance company will only buy me a wristwatch of 10,000 Rand, even if I have 20,000 Rand with them. So that is why most people will prefer to go for under insurance instead of going for over insurance. What is over insurance? It's when the item is insured for more than, please underline that, for more than the actual market value. Businesses, individuals will not, please underline that, receive a payout larger than the value of the loss at the market value. This means that the extra money paid for the premiums will not be paid to the insurer. So the moment you over-insured your asset or your property or whatever good you have, whatever valuable, you do not get more than the value. So that is why most people always go for under insurance, and they'll prefer to add the excess if need be. So yeah, and we have insurable risk. It kept on popping in every now and then. Insurable risk that can be shifted to insurance companies to minimize the financial impact of the losses. Risk that can be carried out by insurance company. Non-insurable risk that cannot be shifted. It's just the opposite. It cannot be shifted to insurance companies. Businesses, individuals must carry out such risk by themselves. For example, shoplifting, changes in technology, changes in fashion. Insurance company cannot work out a premium. Insurance companies cannot work out a premium that the business must pay. In that kind of situation, it's very difficult to calculate the premium that the business must pay. So instead of that, insurance companies do not cover all those kind of losses. Let me take for example, yeah, in terms of flooding, it's actually very difficult to calculate what the premium could be for a business or for an individual. The insurance company finds it very difficult. When the moment they find it difficult to calculate, okay, what your premium could be every month, then it can be classified as a non-insurable risk because it's so difficult to come up with what your premium is going to be at the end of the day. So that brings us to the end of the concept. And tomorrow I will be looking at the calculation. What kind of calculation does insurance company use to pay out the insured when you under-insured your goods, when you over-insured your goods? What is the calculation? How do you get paid out? What is going to be your payout money, and how does the business or the insurance company actually determines that? And also tomorrow I'll be talking about different types of insurance. We'll be talking about the compulsory and the non-compulsory insurance, and we'll be looking at the types of all those insurance. It's such an interesting topic, and we're going to look at and tomorrow I think I will be rounding up on insurance company. Good afternoon.